There is a city in Switzerland that most people pass through without a second thought. It is quiet, efficient, and unremarkable, in the way only Swiss cities can be. But hidden inside it is a place where the modern financial world is quietly engineered. Not debated in parliaments. Not voted on by citizens. Not explained on the evening news. The rules that govern how banks behave, what risks they take, who gets credit, and who does not, are shaped far from public view by a small group of central bankers and regulators who rarely appear in headlines. Their work does not feel political, yet it shapes the economic fate of nearly every country on earth. This place is not a bank in the way most people understand banks. It does not take deposits or issue loans. It does not advertise. It does not answer to voters. It exists above national borders and operates with legal protections, normally reserved for embassies. Its meetings are private. Its documents are sealed. And its influence reaches into every mortgage, every business loan, and every financial crisis of the last half-century. This institution is the Bank for International Settlements. And the framework it oversees has quietly become the operating system of global banking. The rules created under this system are known as the Basel Accords. They do not tell banks what they must do. They tell banks what they are allowed to survive doing. They define how much capital must be held, what assets are considered safe, which activities are punished, and which are rewarded. Over time, these rules have reshaped banking from a business built on judgment and relationships into one dominated by formulas, compliance, and regulatory optimization. The consequences of that transformation are still unfolding. The origins of this system were not born out of ambition, but fear. In the 1970s, international banking expanded faster than anyone expected. Money moved across borders instantly, but regulation stopped at national lines. When a mid-sized European bank failed during the middle of a trading day, the shock rippled through the global system in a way regulators were not prepared for. Transactions were frozen. Obligations went unpaid. Trust evaporated in hours. What terrified policymakers was not the size of the failure, but the realization that no shared framework existed to contain it. In response, central bankers from the world's largest economies began meeting informally. Their goal was not to micromanage banks, but to prevent panic from spreading across borders. They wanted a common language for safety, a minimum standard that would apply regardless of nationality. What emerged from those discussions was the idea that banks should always have a buffer of their own money at risk, something that could absorb losses before depositors or governments were forced to step in. That idea eventually solidified into the first Basel framework. On paper, it was deceptively simple. Banks would be required to hold a minimum percentage of capital relative to their assets. If losses occurred, that capital would take the hit. The higher the buffer, the safer the institution. This approach appeared rational, mathematical, and neutral. But the simplicity masked a deeper question that would define everything that followed. What exactly counts as risk? To answer that, regulators introduced the concept of weighting assets by perceived safety. Not all loans were treated equally. Lending to a government was assumed to be nearly riskless. Lending to households carried some danger. Lending to businesses was considered riskier still. By assigning numerical weights to these categories, regulators transformed qualitative judgment into quantitative calculation. Risk became a spreadsheet problem, rather than a human one. This single decision reshaped global finance. Banks quickly learned that some assets were cheaper to hold than others. Not because they were inherently better for the economy, but because regulators said they were safer. Government bonds, assigned the lowest risk, became incredibly attractive. Mortgages, given favorable treatment, expanded rapidly. Business lending, especially to smaller firms, became comparatively expensive. Over time, banks adapted not to market demand, but to regulatory incentives. This was not an accident. The framework worked exactly as designed. Banks became safer on paper. Capital ratios improved. Crises appeared less frequent. But beneath the surface, the structure of the economy was changing. Governments found eager buyers for their debt. Housing markets expanded aggressively. Productive investment shifted away from innovation and toward assets that looked good in regulatory models. Banks, being rational actors, did not stop there. They searched for ways to maximize returns within the rules. If holding loans was expensive, but selling them removed the capital requirement, then selling became the strategy. Financial engineering flourished. Loans were bundled, sliced, repackaged, and sold as securities. Risk did not disappear, it moved, and because it was now dispersed and disguised, it became harder to see. As the system grew more complex, regulators responded with more complexity. The second iteration of the Basel framework attempted to refine the crude categories of the past. Risk would no longer be estimated broadly. It would be measured precisely. Credit ratings would determine capital requirements. Sophisticated banks would be allowed to use their own models. Mathematics would replace blunt rules with scientific accuracy. What this actually did was embed assumptions directly into the heart of the system. It assumed rating agencies were reliable. It assumed models could capture rare events. It assumed incentives would align with stability. In practice, it did the opposite. Risk was underestimated because models were calibrated on calm periods. Banks optimized for capital efficiency rather than resilience. The system looked stronger just as it was becoming more fragile. When the global financial crisis arrived, it exposed these weaknesses brutally. Institutions that appeared well capitalized collapsed within days. Assets labeled safe became toxic overnight. Liquidity vanished. The problem was not that the rules were ignored. The problem was that they were followed. In the aftermath, regulators faced a choice. They could abandon the framework, or they could reinforce it. They chose reinforcement. The third Basel iteration dramatically increased capital requirements, introduced leverage caps, and imposed strict liquidity rules. Banks were required not just to survive losses, but to survive sudden funding freezes. On the surface, this made sense. The crisis had shown that solvency meant little without cash. But safety came at a cost. Holding large amounts of low-yield liquid assets changed banking economics. Lending became less attractive. Market making declined. Flexibility disappeared. In moments of stress, banks that once acted as shock absorbers became spectators, constrained by ratios they were forbidden to breach. The system became safer individually, but more brittle collectively. This rigidity revealed itself during periods of market strain. Even when banks had ample reserves, they were unable to deploy them without violating regulatory thresholds. Liquidity existed, but it was locked behind compliance barriers. When intervention came, it came not from banks, but from central banks expanding their balance sheets once again. At the same time, traditional banking retreated from parts of the economy it once served. Small businesses found credit harder to access. Local lending declined. Relationship banking faded. The cost of regulatory compliance made smaller loans uneconomical. Scale became an advantage. Complexity became a moat. Large institutions adapted. Smaller ones struggled or disappeared. Consolidation accelerated. The very banks deemed systemically dangerous became systemically indispensable. Regulation intended to limit dominance entrenched it. Meanwhile, the demand for risk did not vanish. It simply relocated. Credit flowed into private funds, non-bank lenders, and lightly regulated markets. These entities operated outside the Basel framework, free from capital and liquidity constraints. They took on the risks banks no longer could. The system became bifurcated. Safety in the regulated core, risk in the shadows. The foundation of the entire structure rested on one assumption that few questioned openly: that government debt was effectively risk-free. This belief justified preferential treatment. It encouraged concentration. It linked banks and states together more tightly than ever. When interest rates were low, this arrangement appeared stable. When rates rose, the hidden vulnerability became visible. Bond prices fell. Losses accumulated. Accounting conventions masked the damage. On paper, institutions remained sound. In reality, their margins of safety narrowed. A system designed to measure risk had institutionalized a form of denial. At the geopolitical level, the framework also reflected an era that may be ending. It assumed global cooperation, shared standards, and neutral finance. As sanctions, fragmentation, and strategic competition increased, those assumptions weakened. Not all countries view the rules as impartial. Alternatives are emerging. Parallel systems are forming. The Basel Accords were never presented as a political project, yet their consequences are deeply political. They shape who gets credit, which sectors grow, and how power is distributed within the financial system. They privilege certain assets, institutions, and behaviors while penalizing others. They protect stability, but often at the expense of dynamism. Today, the banking system appears well capitalized and orderly, but calm should not be confused with health. The risks have not been eliminated, they have been displaced. They live in private markets, in sovereign balance sheets, and in assumptions that have yet to be tested under new conditions. The rules that govern banks were built to prevent yesterday's disasters. The question is whether they are preparing us for tomorrow's. Because history suggests that the next crisis will not come from where the models expect it. And when it arrives, it will test not just the banks, but the invisible architecture that claims to keep them safe. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin. And don't forget to hit that bell icon so you never miss our latest videos.